Position sizing is probably another very important topic to discuss and talk about. A lot of people don't give it enough credit. What we really focus on is the hot stocks. That's what the news wants to report on. What's moving, what's Jeff Bezos doing, what's Bill Gates doing with their stocks. We want to talk about that. But we don't really talk about managing risks, and even talking about it in the past in this channel and on YouTube. A lot of people gravitate to how to make money fast, how to make money quickly, how to become a millionaire overnight, and those kinds of things, because we have a get-rich-quick mentality. Our human fallacies kind of play against us, and that's where a lot of people fail in the market. So in today's video, I'm going to go back to basics and kind of chat a little bit more about position sizing, and we'll go to Excel and I'll show you some concepts regarding position sizing. So when we start looking at position sizing, what a lot of people do, I'll show you what most people do in terms of position sizing. We'll go into, I'll just do it in terms of basic shares, and then we'll apply it to option concepts. So they'll go into stock number one, and we can call it Pinterest, Boeing, Apple, and let's say Netflix. So what they'll do is they'll size things up kind of like this. Let's just say we've got 100 shares on each one. And that all seems good in theory, but what happens, and the big issue behind this, is that the weight of Boeing or Netflix is going to be a lot greater than Pinterest. So when you're sizing things up in terms of shares, you got 100 on each, you think you're balanced, you think you're spread out, but you still have a high degree of concentration of risk. So version 2 of this might say, okay, let's beta weight this position. I'm going to show you this concept here, why we're beta weighting. Because if you look on my screen here, I've got a beta weight on the SPY. The deltas here are 45, 16, 15, 33. But if I unbeta weight this, now I've got 1,000 deltas, because this is AAL, so it's a super cheap stock. So even though it says 1,000 shares, really relative to the positions I have, it's not as big as you think. So relative to Microsoft, it's still less than Microsoft, even though Microsoft only has 100 shares, but AAL over here has 1,500 shares. So the point is to beta weight against some kind of index or something to make it a little bit more equal relative to your total position or portfolio. Otherwise, what you do is you have a concentration of risk in Microsoft. And when you have this concentration of risk, then if that stock goes up, you're doing well. If it goes down, you're doing poorly. So you can't really judge it based on the share number. So this is where maybe if we look at something like Pinterest, you might need 500 shares of this, 100 shares of this, 100 shares of Apple, and then 100 shares of Netflix. That starts to become a little more reasonable. And even then, we might even go to something like, let's say, 1,000 shares of Pinterest, maybe 100 shares of Boeing, 200 shares of Apple, and 100 shares of Netflix. That actually starts to become a little more reasonable. Now, I don't know exactly the beta weighting on all of these, but now we're starting to get into version 3, where we're starting to see some form of balance and equilibrium on it. Now, when you start actually going in and now starting to spread position and capital, that's still a fairly significant amount of concentration. Because when you start doing all of these to become bullish, so you might have everything for bullish positions, and this is again what most people's concentration of risk looks like. Everything is bullish. Whereas instead, what we can also do is have one that's bearish. Now you might say, well, I don't want to be bearish Apple. Yeah, okay, that's fine. But the point is to minimize the risk inside your portfolio. It's not about, hey, loving or hating Apple. It's really just about, I need some bearish exposure. That way, when the market tanks, you're not really getting into too much trouble. So now what you're doing is you're allocating a little bit more on the downside. And you could do like 2 bullish, 2 bearish positions. That's totally up to you. You could do even less positions then, but the problem is when you got a lot of concentration here, and this is 90% of your portfolio or something to that effect, that really starts to become a pretty significant problem and issue. So you don't usually want to do something along those lines. You'd rather spread your money, spread your capital. Now, as we start getting into the options world of position sizing, I'm just going to go into here and let's just copy some of these things over in this area. What you actually may end up doing is going into, let's say, vertical spreads. Let's say we are doing vertical spreads, and you might do a few that are bullish and a few that are bearish, but now you're wanting to spread out some capital. But again, you might go in with, let's say this is a I'm going to go with a $50, let's go $100 position, which is just, we're talking about buying vertical spreads. So let's just buy vertical spreads. We'll spend $100 of risk. Now we can actually allocate a little bit better, or it makes it a little more even. If you can do it with Netflix, it's $5 wide, it might be $250. But what we'll do is we could do one contract each, but you can also do one that's bullish, one that's bearish, and we'll do another one that's bullish. So you've got a few different situations here where now we've got some vertical spreads that we're spreading out the position. So I've got this one that's kind of bullish, I've got this one that's also bullish, and I've got these that are bearish. So I've got this concept of one area of my portfolio, and what you can really even do further if we go in and take a look at some of this. Well, now what we can do is do iron condors. So instead of also doing, these are kind of directional trades, we can do the same thing with iron condors on the position sizing, but now instead of Pinterest and these kinds of things, we can do like ExxonMobil, Amazon, let's say NVIDIA, and let's say Microsoft. So now I have a few different positions that I could have, and I might do, you know, again, you might put up, let's go with $500 of risk on each one. Now I've got a little bit more of a variety on that portfolio. Now, the other thing that we start doing is with iron condors, these are more non-directional, and they are making money from theta, whereas these other items are making money from delta. So these are looking for a move or movements. The other thing that you can do in terms of spreading capital is also start looking at the amount of days. So if we start looking for days till expiration, this one might be 30, this is 50, this is, let's say, 60, and this last one could be like a 15-day. So you could be spreading out capital from short duration to long duration as well. And this goes the same thing here. So if we've got days to go, we could do like a 45-day iron condor, a 30-day iron condor, 15-day iron condor, and like a 5-day iron condor. So you could do a lot of different setups here and constructions in order to start minimizing some of the risks or what's going on. So if we look at it, here's our kind of little table, and then here we've got kind of another table. So we've got two baskets to our portfolio a little bit. And now we've got a little bit more of a diversified zone or diversified structure to what we're doing. Now, on top of the iron condors, we've got buying verticals. You can also sell verticals. I mean, you can start adding in, because these are short Vega trades. Here, you can do the same concept with, if you really wanted to spread money and capital, you can do the same thing with calendar spreads. So when you're going in and you're starting to spread capital, this is where having or knowing another strategy is good. And then it also, what it allows you to do is allows you to spread your money. And the more money that you have, more capital you may want to spread your money into, because now you can go into Meta, McDonald's, Home Depot, Goldman Sachs. So we can pull these stocks in: Meta, McDonald's, Home Depot, Caterpillar. So all of these things, we got a calendar spread. We could do kind of one contract on each one. It won't be exactly perfect. Also non-directional, also theta, but now we can spread out these risks. And instead of 45 days, I can go, you know, about 5 days more on each one of them, just to vary this up. And now I've got myself a little portfolio that I'm building, position sizing in different zones. So the point of this is, when we have different trades working in different ways, it allows us to make some profits. As we know, the market doesn't move all the time equally. And in some cases, what might happen is, let's move this area over here. These, in this zone where we have these non-directional areas where we're making money from theta, might work well when the market is not moving, or even just moving slowly, a little up or a little down. Or even if we have a little pause. So you could be profiting from these areas, and it's okay to have them. Sometimes they're not making as much money because the market's exploding to the moon. Now, if it's exploding to the moon, you've got a few things that are also making money in these cases. But if it's selling off, you've got some bearish positions. So as we're looking into sizing up the positions, we want to make sure our capital is split. The issue is that most people go in too big with like this original example where they go in and it's very heavy, and now all of a sudden you're getting into trouble too fast too soon. Even if you have four positions, that starts to become a problem, because really what I normally see is more like they got 600 shares, then like 400 shares, then 500 shares, and 300 shares, and it might be the 400 shares is like on something like a Tesla, and then it goes down, and now it becomes a huge problem and issue. So instead, what we'd like to do is spread up capital into different zones. So here's kind of our non-directional trading in this area. Then what we could do is do some more directional trading, and you can even do directional condors, directional calendars. But what you'll want to do is slowly just kind of allocate it in different ways, because that way, if the market's moving, um, you're not going to get as badly hurt or damaged. So you could do directional spreads. So that could mean like even calendars, or even diagonals. So what we'll be able to do is structure these along the lines of, let's say we go into a calendar spread, and I go into, we'll just do GoDaddy for now. I can still do a bullish calendar spread. Let's go to, well, switch to Home Depot. A little bit better positions, but current price is 305. I'm going to do a calendar at 310. And as I put this position on the simulation, what you're doing is now I've got a little bit of a directional bias on this move, where if the stock starts heading higher, I still get the theta decay. Now, if it explodes, I'm going to overshoot it. But the point is that now I've got some capital spread in different zones to be able to kind of profit from a movement that's maybe not as extreme. And you have the verticals, and you have other things there as well that you might position in different zones. But this is how you start thinking about position sizing as you're starting to go. The other thing is that can you handle multiple moves? So when we start looking at let's say move one, move two, move three, handling multiple moves is that if you're risking, let's say $100, then on the next trade, what are you going to risk? Are you going to increase your risk thinking you'll profit from it? Like, let's say you risk 150, or then 200, and then 250, where now the 250 will help make up some of these losses before. Or are you going to kind of keep your risk the same? I will say that, the chance of that trade working out is always the same probabilities, because you still have kind of a win or loss. And most people think, though, by the third round, or the fifth round, or the sixth round, statistically speaking, they should win. And this is where they start increasing their bet. This is kind of the gambler's fallacy, where you start increasing your bet size to try and make up some of the previous losses. And in theory, that's true, but there is a time where you might, hey, you were trying to make $100, but you're risking 1,000 now to make that 100. So it can become a problem. Doing it kind of 2 rounds in, or 3, can be okay. But once you get beyond like a 3R move or so, or 3 times more than what you were willing to risk, and you're losing that can become an issue and problem, because then you can wipe those out. So instead, a lot of times it may be wiser to, let's say you go to 100, then you go to risking 200. And now if you lose that one, just stop, and now move on to kind of the next trade, and just again, go back to 100, then go back to 200, maybe you won. Okay, then back to 100, then you might have won, then 100, you might have won. So trying to keep those things consistent is fine. But if again, you get that 100, then you're losing 200, you could say, I'll try a third time. But if you lose that 300, now you lost 500, $600. So you lost $600 to make $100. That becomes a problem. So watch out for these kind of increasing these risks as things are going against you. This happens a lot. Like, let's say the market's starting to pull back or going down, and you might see it kind of in these concepts where stock is tanking, and then, like the dollar cost averaging concept. You keep adding, which you don't want to do in the market. The good thing about the market is, rather than on the gambling side, like you're kind of sitting there at a table, here what you could do is put on a longer duration position if you're doing with options. Or you could go, instead of 100 shares, because that's what people do, they go another 100 shares, then another 100 shares, then another 100 shares. Just buy 1 share a day. 1 share, 1 share, 1 share, 1 share, 1 share, 1 share. It kind of fulfills your personal need or desire to be in the trade, and then on the other hand, it limits you to adding too much too quickly. So anyways, it's just a few mental tricks for yourself that you might want to look at. Anyway, I hope this helps, gives you a little insight. Definitely highly encourage you to check out some of the other courses we have on our website on tradersfly.com. There's a lot of good stuff over there, a lot of freebies, but hopefully this gives you a little insight to position sizing and trading, spreading capital, portfolio construction, and building things out. So anyways, it's just a starting point. This subject can be very deep, and we could spend hours upon hours and even days just talking about this subject. But just to shed some light for some people that are getting started in the matter, this is how you might want to start thinking about it, especially as you start getting into 6-figure accounts or 7-figure and 8-figure accounts. You definitely need to spread money and capital in many ways, because those positions can grow quite quickly, and you'll have a very high degree concentration of risk in some of those areas if you don't spread your money, and that can be a recipe for some serious problems. Anyways, thanks for joining me, and I will see you in the next video. Take care.